Professor Namyong Lee's long-form commentary, The Korea-US Dollar Exchange Rate as a Composite Indicator of the Lee Jae-myung Government's Foreign, Security and Economic Performance. When a government's trust premium erodes, the exchange rate is the first to issue a warning. As the $1 rate wavers around the mid-1470s and the 1,480 threshold again enters public discussion, explanations that rely solely on interest differentials, trade balances, or short-term supply and demand are insufficient. The exchange rate is not merely the outcome of economic variables, it is the market price of confidence in politics, security posture, and policy coherence. Markets price predictability, not goodwill. When predictability weakens, a risk premium is imposed on the currency. Once that premium takes hold, even strong real sector fundamentals, such as persistent current account surpluses, may fail to support the currency. This is not a value judgment, it is a warning delivered by prices. Households and firms respond not only to numbers, but to lived experience. When confidence in the preservation of purchasing power falters, dollar preference becomes routine, and routine behavior becomes the baseline of the foreign exchange market. Once that baseline shifts, ad hoc interventions or one-off messages lose effectiveness. Hence the proposition that without restoring trust, all remedies are futile. Trust restoration must move beyond slogans toward measurable, repeatable protocols. Global standards and world-class practice converge on one core principle: rules-based governance. The problem is not intervention per se, but intervention without principles. In monetary policy, too, credibility rests less on the level of rates than on the reliability of the reaction function. A reaction function is a credible commitment that allows markets to anticipate how authorities will respond under defined conditions. When that commitment blurs, conjecture fills the void, and conjecture enlarges the risk premium. This is where real sector resilience collides with financial currents. By standard metrics, Korea's real economy has provided a buffer. A sizable current account surplus, both monthly and cumulative, would ordinarily support the currency. The persistence of a weak won under such conditions indicates that capital account dynamics are exerting greater influence than trade flows. In other words, the waveform of financial flows now dominates the exchange rate more than the sum of merchandise transactions. What markets scrutinize more closely than the absolute size of foreign exchange reserves is the predictability of their use. Adequate reserves without clear operating principles breed anxiety, while the same numbers under transparent rules convey stability. The exchange rate is more sensitive to the quality of interpretation than to the magnitude of figures. For this reason, foreign exchange policy must privilege rules over aggregates. When rules are firmly established, the cost of volatility declines. External conditions matter, of course. A strong dollar and a weak yen can weigh on the one. Yet external forces are shared across countries. Risk premia are not. Those premia differ according to policy predictability and national credibility. The phenomenon in which large current account surpluses fail to strengthen the currency emerges when the trust premium weakens. Consequently, the only durable remedy for a surging $1 rate is for the Lee Jae-myung government to restore credibility on its own terms. A clearer prescription emerges by dissecting the stakeholder network. Viewed as a system, the exchange rate reflects signals from the government, the foreign exchange authority, and the central bank. Real sector flows from exporters and importers, the velocity of capital from foreign investors and global financial institutions, the demand patterns created by pension funds, insurers, and asset managers through overseas investment and hedging, and the sentiment of households expressed through saving and consumption. These actors may appear independent, yet their signals amplify one another into a single wave. The weakest link in this network is the interface, the point at which official statements are translated into market expectations and central bank communication is mapped onto interest rate and exchange rate forecasts. When predictability is high, the interface hardens and trust accumulates. When predictability falters, the interface loosens and conjecture prevails. Under conjecture, markets default to conservative positions, favoring dollars and driving the exchange rate higher. From an enterprise architecture perspective, high-performing states decompose functions, clarify accountability and interfaces, and standardize data and rules to enhance predictability. In Korea's case, foreign exchange intervention, monetary policy, fiscal signaling, pension fund operations, and private sector hedging together form a single service chain. Bottlenecks typically arise not from insufficient resources, but from weak trust at the junctions. Strengthening those junctions requires aligned rules, transparent data, and clear responsibility. When alignment is achieved, the structural cost of exchange rate stability falls. Recent remarks by Bank of Korea Governor Jae-myung underscore this logic. Following the decision to hold the policy rate at 250%, the governor emphasized exchange rates and financial stability as decisive considerations. The implication is that if monetary policy is interpreted solely as moving toward easing, exchange rate expectations may tilt upward again. Forward-looking assessments by Monetary Policy Board members favoring a pause and tempering expectations of further cuts reflect an effort to manage expectations and reduce volatility. Markets seek not a single forceful decision but a consistent reaction function. The governor has also cautioned that the current level of the $1 rate diverges materially from Korea's fundamentals. Given the country's status as a net external creditor and its sustained current account surpluses, simplistic comparisons with past crisis episodes are misleading. At the same time, exchange rate depreciation can pass through to import prices, feed into inflation, and disproportionately burden domestic firms and vulnerable households, exacerbating inequality. The crucial point is that the exchange rate is not merely a price, but a composite indicator linking distributional outcomes and perceived economic conditions. Monetary policy, therefore, must jointly consider inflation, financial stability, and the exchange rate. Another salient concern is the expansion of residents' overseas securities investment, which can temporarily amplify imbalances in foreign exchange supply and demand. The growing market impact of large institutions' overseas allocations and hedging strategies has been repeatedly noted. When combined with the routinization of household dollar purchases, these forces can magnify volatility. Short-term fluctuations are ultimately the product of missing rules and concentrated expectations. In this light, the governor's remarks should be read not as a pledge to defend a level, but as a signal of intent to recalibrate expectations. Curtailing the routinization of dollar preference requires rules, not persuasion. Household dollar buying reflects perceived insecurity in currency value rather than speculative fervor. Repetition alters baseline demand, and once habit forms, isolated messages lose traction. Assigning blame to households worsens the problem. Anxiety recedes when risk is reduced through clear rules. Such rules rest on transparency and consistency. The Foreign Exchange Authority must repeatedly articulate the principles governing its actions. The central bank must clarify the conditions and indicators that shape its priorities, and institutional investors' hedging and overseas investment practices must be anchored in disclosed frameworks. Secrecy breeds conjecture. Conjecture enlarges premia. Premia lift the exchange rate, and higher exchange rates intensify anxiety. What citizens ultimately seek is not theory but assurance. When confidence in the preservation of purchasing power erodes, consumption weakens and overseas asset preference rises. Weaker consumption dampens domestic demand, delays investment, and feeds expectations of slower growth, expectations that, in turn, weigh on the currency. Exchange rate instability thus disrupts both financial markets and the real economy virtuous cycle. The linkage between monetary policy and prices must be monitored quantitatively. Currency depreciation raises import prices, which can spill over into consumer inflation. In such an environment, rate cuts may simultaneously affect inflation expectations and exchange rate expectations. Holding the policy rate at 250% can therefore be understood not as undue conservatism, but as an effort to manage the nexus among exchange rates, prices, and financial stability. Monetary policy in practice is a multi-objective optimization problem. Here conditions matter more than outcomes. Authorities must articulate the thresholds at which combinations of responses will be deployed across exchange rates, inflation, and financial stress. Discretion is necessary, but discretion, bounded by principles, differs fundamentally from arbitrariness. Markets fear arbitrariness most. When fear rises, dollar preference strengthens. When dollar preference strengthens, the exchange rate rises, and rising exchange rates further constrain policy. The same logic applies to government policy more broadly. Frequent shifts in regulation, taxation, industrial policy, labor policy, or energy pricing erode investment planning and redirect capital toward overseas assets and dollar demand. Under such conditions, current account surpluses lose their currency supporting power. Intervening in flows while undermining predictability produces perverse outcomes. The least costly path to exchange rate stability is the restoration of predictability. Foreign exchange buffers must therefore be automated and institutionalized. Verbal intervention may buy time, but it cannot alter structure. Structural forces, habitual household dollar buying, and expanded institutional overseas investment require institutional responses. Transparent hedging principles for pension funds and institutions, guidelines that smooth the timing of dollar demand, and rule-based mechanisms that activate automatically during stress are essential. Markets fear not intervention, but intervention without rules. Abrupt swings in foreign capital flows also amplify upside pressure on the exchange rate. Inflows exert downward pressure. Outflows push rates higher. Restoring trust to reduce extreme swings is thus critical. When volatility subsides, trust rebuilds, and a virtuous cycle emerges in which micro measures gain durability. In conclusion, with robust real sector capacity reflected in large current account surpluses, inflation running in the low 2% range, and a policy rate constrained at 2.50%, managing the exchange rate through flows alone is ineffective. Re-establishing sound principles in national security and economic policy would allow the $1 rate to fall. Without restoring the confidence of firms and citizens in the Lee Jae-myung government, however, no remedy will suffice. Thank you for watching Professor Namyong Lee's long-form commentary.